So when we're talking about diversification, what does that even mean? And what's really cool is that we could break this down into four important subtopics, which is the covariance, correlation, the mean variance relationship, and then the notion of diversifiable risk. All right, so let's start with that and let's see where this brings us. So let's begin with this idea of covariance and this idea of correlation. But to make it simple for us, what we're going to do is we're going to look at an example and kind of try to flesh it out together. And hopefully, just hopefully, it gives you some context into what this means and how this should be applied. So what we're going to do, as you can see on the screen, we have essentially two rows and then three columns, okay? We're going to begin with the first column at which you see clearly Bitcoin here and the Standard & Poor's 500. To just give you context, if you don't know what those two things are, Bitcoin is obviously a cryptocurrency, probably the most famous one out there. Then the Standard & Poor's 500 is just the long way to say the S&P 500, which is another way to say the market portfolio, i.e. the market index, okay? So what I'm trying to draw upon here is that let's say that every single time Bitcoin's value increases, the value of the S&P 500 would decrease. What would this mean? Imagine you were able to figure that out. Imagine you were able to figure out that at any time the direction of Bitcoin goes one way, the direction of the S&P 500 would go the other way. That would be a pretty good investment scenario, right? Because you would know exactly what to do and when to do it. Obviously, in real world, that's not necessarily the case, but there's a conversation about Bitcoin being totally uncorrelated to the S&P 500. But I don't think that's the case anymore, especially with how the market is going. But that's a really cool idea. So the first column really tries to address, well, hey, if one asset class increases, the other asset class decreases, clearly there seems to be some sort of negative relationship, right? They're moving in the opposite direction. That's really interesting, right? One goes up, the other goes down. The other goes up, the other one goes down. Super interesting. Let's move on to the second column, in which, as you can see, we have a home, okay? This is a proxy for the real estate market. And then we have Tesla, which is right here, Tesla stock, okay? So imagine we said, hey, every single time the prices of real estate increases, the price of Tesla stock will increase as well. This is what we denote as being a positive relationship. As one increases, the other increases as well. And by definition, if they are moving in the same direction, if they're moving in tandem in the same direction, we could also say that if the prices of the real estate market, right, were to decrease, then we would also assume that the price of Teslas will decrease, i.e. the price of their stock. Super interesting. Now let's look at the third column in which, well, if the price of Facebook decreases, we're not too sure what happens to Apple. It could go up, it could go down, we don't really know. And vice versa. If Facebook's app, if Facebook's stock would to increase, let's say, we still wouldn't know necessarily what would happen to Apple stock, right? That would mean that maybe the relationship isn't so fleshed out. Maybe it's not as positive and or negative of a relationship. What we just did here is we just discussed a little bit in a more, I guess, intuitive way, what the covariance and what the correlation coefficient really tries to display. The covariance and the correlation coefficient tries to assess, right, what is the effect of one item's movement to another item. And in the scope, I guess, of finance, we're trying to assess, well, how will the returns of one specific asset or one specific security will affect the returns of another asset's returns. So what we try to do here is that if we're able to figure out, well, hey, when Tesla stock increases, the stock of Facebook decreases, well, then maybe we're able to have a really good hedging opportunity in terms of our investments, all right? But before we go so far, I would like to discuss two quick things about the bounds of the covariance and the bounds of the correlation coefficient. The covariance is a very cool tool, and we'll talk about it a little bit later, but I just want you to remember one thing is that its bounds are infinite. So when you get the output of your covariance formula, you're going to get a number, right? The number could be positive and the number could be negative. The thing is, the magnitude of those numbers could realm all the way to infinity. So it makes it very, very, very hard to assess, well, what the heck is it even talking about, right? What is the difference between a covariance, i.e. a positive of like, call it 5 or 10 or infinity plus 1 or infinity minus 1? What does that really tell us in terms of magnitude? To what extent is that relationship positive if it could go all the way to infinity? What is the most extreme positive relationship available in terms of the covariance? It's very hard to assess if it's bounded by infinity. On the other hand, when we discuss about the correlation coefficient and why it matters so much and why you've seen it in the formula of your standard deviation text, like your standard deviation formulas in your textbook, or when you read financial articles, they discuss this idea of the correlation coefficient. Well, it's so important because the correlation coefficient is the covariance standardized. In other words, it's essentially the covariance, right? The same idea of measuring the relationship of two different items, but doing so with finite bounds. So when you get the output of your correlation coefficient, you get a number between -1 all the way to 1. Now, not only are you able to assess whether a relationship of two items is positive and or negative, you're also able to make a way better interpretation of the magnitude of that relationship. Obviously, if the maximum value is 1, well, by definition, you know that's the most extreme positive relationship available. And on the other hand, if your output for your correlation coefficient is -1, well, you know that's the most extreme negative relationship between two items. So that's really, really interesting. Now, before we kind of talk more about the implications of the covariance and the correlation, I'd like to maybe move on towards this idea of the mean variance relationship. And really, why do we care about it? So as we discussed earlier, okay, is that we could, invest in a bunch of different stocks. We could invest in a bunch of different asset classes in the hopes of being able to build a portfolio. And what I'd like to cover super quickly is this idea of portfolio theory. How do we build out a portfolio really quickly, assuming that we know, or we hope that we know, their returns and their risk factors. So if you look at the right-hand side of the screen, I'm opening up an Excel. And on that Excel, we're going to look at a few topics really quickly. All right, hopefully this is visible, okay? So on the top left-hand side, we have a little table in which we have our assets, expected return, and standard deviation on our columns, and then in our rows, we have security A and security B, then obviously their expected return and their standard deviation. Now, assuming that we already know their expected return, so 12% and 5%, and then the risk of 12% and 6%, we're able to assess all the different combinations of risk exposures to this portfolio. Now, what's really interesting, and is hopefully clear and highlighted right here, is that you could see that we could have different relationships for our risk, right? Different combinations for our portfolio will yield different risk factors for our portfolio. But what's really even more interesting is that depending on the correlation of these two assets, i.e. security A and security B, you're going to have a different realm of possibilities available to you in terms of risk profiles for your portfolio. So let's do a quick example. Remember, we said that the covariance is bounded by -1 all the way to 1. So in this case, we have we have -1. So if you look at your standard deviation of your portfolio right here, is that you can see that there's a point, right, that we are able to get a return, a risk of 0%. What if we knew that the correlation coefficient was 1, that they move at the extreme most positive relationship, such that our realm of possibilities in terms of our standard deviation of our portfolio will be a linear line, essentially it will be a straight line. But what happens if the relationship is more so 0.5? Well, now the realm of possibilities is a little bit more skewed, okay? What about 0? Well, it's even more skewed. What about -0.25? And then we could look at -0.8. there are a bunch of different realms of possibilities based on the correlation coefficient that we have between two assets. So that's really interesting. And the last thing I'd like to say is that notice the risk factor of security A and security B. Security A's risk factor is 12%, and security B's risk factor is 6%. If you don't see that, it's really written right here, 12 and 6%. And notice that the standard deviation of that portfolio, right, in this case, is 2.77%. Okay, so what's really interesting, and we could even, I'll try to flesh it out even more. If you look at our graph here, okay, we have the risk profile of both assets. Notice that we have 6% here and 12% here. Okay, so this is if we're fully invested into A. This is if we're fully invested into B. But what's really awesome is that when two assets have a correlation coefficient that is smaller than 1, we're able to earn a portfolio standard deviation that's actually smaller than both those individual assets. That's this idea of diversification. The idea that we're able to minimize our exposure to risk the more we spread ourselves throughout investments, the more we invest into investments that are negatively correlated, such that the positive outburst of one investment that is followed by the negative outburst of another investment could be used to your advantage to minimize your risk even further. So notice that here we have a correlation coefficient of minus 0.8, right? And that enables us to have a risk profile that is 2.77, all right, 2.77%. But if our correlation coefficient was 1, well, our risk profile jumps all the way to 7.5%. So obviously, there's a huge factor to this idea of the correlation coefficient, okay? And then our correlation coefficient really just, when it's at 1, really just provides a portfolio standard deviation that will be between the standard deviation of security B and between the standard deviation of security A. All right, just a few pointers there. And why does this matter for us? Well, the first person that figured this out probably thought they landed on a gold mine, right? I don't know who it was, but it's a really cool thing to consider and to understand. And with that said, if you're a rational investor, you'd be like, okay, clearly there's an infinite set of portfolios that we can invest in. But even before that realization, there's an infinite set of combinations available to us in terms of our investment, our portfolio investments, right? You could be invested 1% into security A and then 90% invest into security B. But then you could say, okay, well, I'm going to be 1.25% invested in security A and then obviously, and so on and so forth with security B. So there's a endless combination subset available to you. Now, what we want to do is obviously we want to figure out, well, what is, for example, the combination that minimizes risk? What is, for example, the combination that maximizes risk? What is, for example, the combination that maximizes our return for the given level of risk we've undertook? Or even, what is the worst outcome out there? And we are able to plot all those things out, all of these different outcomes, thanks to the mean variance graph, thanks to essentially the efficient frontier, in which the efficient frontier lies on the mean variance graph. And what's really cool is that if we take a look at that right now, is that we're able, and I plotted quite a few of these bad boys, but we're able to see all the different realms of possibilities in terms of returns for a 2-stock portfolio and so on and so forth, a 3-stock portfolio, a endless portfolio, blah, blah, blah. And as you can notice is that, okay, well, we have a bunch of different portfolios, right? Which are going to provide, a given level of returns, right? And a given level of risk. So if we go here and we look at this graph here, we're able to notice, okay, well, clearly the point at which we have the least amount of risk would be here. However, is that the amount that gives us the best risk to return or return to risk ratio? We don't know. So we look at every single one of them to figure out, well, which one gives us the best returns for the unit of risk that we take. And depending on the type of investor we're dealing with, maybe some investors will want to invest in a portfolio that just minimizes risk. Maybe different investors will want to invest in a portfolio that doesn't minimize risk, but that gives them the best ratio of returns to risk, okay? And what I just addressed here, what I just talked about is this idea of the mean variance ratio that we're going to try to optimize for typically. And people will also look at the Sharpe ratio, which looks at essentially the risk premium divided by the unit of risk taken on an investment. Now, these are a bunch of different topics, which I won't spend too much time on, but I hope this is an okay introduction to the whole idea of the mean variance graph, okay? The relationship of returns to risk and how for any combination of assets or any combination within a portfolio, we are able to plot them on an efficient frontier and then kind of figure out, well, how do we optimize for the least amount of risk, the most amount of returns, or the best ratio of returns to risk, and so on and so forth. And then the final topic that I'd like to discuss is, which is diversifiable risk, okay? And this is something that maybe will not be covered right now within the realm of this idea of covariance and correlationships, but it's pretty important to understand. And we could break down diversifiable risk into two factors, right? The unique risk and the market risk. Essentially, unique risk, which is individual risk, and then market risk, which is systematic risk. When we're talking about unique risk, we're really trying to talk about risk that is quite literally individual, that is unique to a given company, to a given investment, to a given asset. It's risk that only that specific asset may deal with. It's not something that is shared by everybody. That is not 100% shared by everybody. Now, for sure, one's unique risk may be similar and or equal to that of somebody else's, but it's not a mandatory, it's not a law, it's not a rule. I feel like maybe starting with this idea of market risk would be better. So I'll give you guys just a good example. I think the pandemic was a very good example of what market risk is all about. It was a major force that all realms of businesses, all industries, and all functions had to deal with. No matter who you were, you could not escape the early onset of the pandemic and how it affected cash flows and businesses. That's when we talk about market risk. However, unique risk, for example, could be, let me give you a quick example. I'm trying to think about it. It could be, it could be like unique risk could be businesses in the States or businesses within cities that are related to the NBA franchise. And when the NBA franchise model decides to do a CBA, so a collective bargaining agreement, they stop operations. They stop, holding their games for a few months, even seasons, and a lot of people were going to lose some of the money they would make, right? If there are no basketball games for a year or two, well, obviously arenas are going to be closed for some time. So a lot of people won't be able to work, let it be coaches, let it be people who sell hot dogs in the stands, things of that nature. So that's a good example of unique risk. Another good example of unique risk would be if there's a regulation within a specific association and or country for, call it airlines, or a regulation for telephone makers or telecom companies who have to now disclose even more information on how they deal with compliance. Those effects may cause more financial burdens on this company. So that's what we call unique risk. And notice how I had to work to find those examples. I had to think about it, right? Because unique risk is really kind of subjective to the company or to the industry that we're dealing with. Whereas market risk is a major force that nobody could run away from. And I feel like I took a little bit too much time trying to talk about that concept. But what I would like to do is tie a bow on that concept of diversifiable risk. This idea here is that, sure, what we looked at prior was this idea that the more you invest, right? And as soon as you invest, if you invest correctly, you're going to be able to benefit from diversification benefits. You're going to be able to minimize risk. However, there is a point at which you are no longer able to minimize risk. There's a point at which you attain market risk. Market risk is something that is not diversifiable. It's something that you cannot escape from, okay? You can do as much as you can, but at a certain point, you won't be able to eliminate market risk. However, you are able to eliminate unique risk as you diversify your portfolio, as you invest in different asset classes that are uncorrelated and so on and so forth. Okay, now that's something super important to understand. Now, hopefully this helped. Hopefully this gave you some sort of, I guess, perspective on the topic. For sure, I'm not a teacher. I guess I was a student just like yourself, and I'm just trying to build some sort of conversation here, trying to give you more perspective really on these topics. And once again, diversification can be broken down into 4 important subtopics, right? Covariance, the correlationship, the mean variance relationship, and then notion of diversifiable risk. If you want to try to expand your knowledge on these topics and really test them out, I have a few questions at the end of this module, at which you're going to be able to just try some questions out, try to explain a few topics out, and you could find the solutions in the description below in a separate document. But question 1 really looks at, once again, the 2 metrics that measures how returns move relative to another, which obviously is the covariance and the correlationship. And the second question just looks at how do you maximize return for the level of risk undertaken for a set of investments, and you would choose the best one out of there. Okay, so simply what you need to do is take your expected return and divide it by your variance, and the one that gives you the best ratio out there will obviously would be the best investment in terms of that risk to return trade-off. And then there's another question, question 3, which looks at the worst return to risk trade-off. And that's pretty much it. Hopefully this helped. Listen, it's a conversation on diversification in under 20 minutes, I guess. And once again, yeah, let me know if there's some BS in here. If it's wrong, I'm more than happy to help. I use this as an opportunity to kind of broaden my knowledge as well, right? This is an amazing kind of pretext and or habit to have that I'm doing, and it's pretty fun. So once again, just let me know if I'm wrong. I'm totally okay with probably being very wrong, but hopefully this was a conversation that it helped you out, and that's what this is all about. So yeah, bye bye.